Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the last week in Mortgage Today, our weekly walk through all things mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host. And this week, my friend, fellow Clevelander, the EVP over at Nations Lending Corp, Eric Roman. Eric, thanks for joining me today, bud.
You got it. Thanks for having me, Rich.
To level set with the listeners to start, Eric, how did 2020 end up? 2021 Q1, any notable items that you have in the hopper, initiatives, general vibe? You give like a little overview of Nations for the listeners before we go ahead and get started here.
Yeah, you got it. So 2020 was a record year for Nations. You know, the pandemic was kind of the perfect storm for us. You know, we anticipated growth, but, you know, we probably had 100% uptick from where we were the previous year. So really great year, really helped us to kind of continue to build the war chest for future initiatives. So really excited to kind of come off the heels of that and continue down that path with further growth in 2021.
That's awesome. It's such a great story, Nations. I know it because I'm a Clevelander. They're headquartered here. But I mean, you know, not too long ago, 7-8 years ago, like primarily a refinance shop, Eric and other talented leaders at that organization really just turned the organization around and, you know, has been really just great growth over the course of the last several years. And one of our earliest members, and I appreciate, Eric, you kind of taking a chance on TMC when, you know, before it was fashionable. So I appreciate it.
Yeah, there was really no looking back. That was an early decision that we made, and it made a lot of sense at the time, and it's been great ever since.
Outstanding. So
yeah, we Rich, we grew up as refi guys, right, for so long, so we just know it really well. And last year, the pandemic kind of played into that market and that rate environment. So even though we have pivoted to retail and our focus is growing purchase on the go forward, we still do have a good segment of CD guys that operate really well. And they were able to kind of just, you know, maximize on, you know, 2020 and even going into 2021, turn those dials and continue to, you know, facilitate that refi business.
That's awesome. And this is the last week in Mortgage Today. For those of you that are just getting logged on now, Rich Swerbinsky with the Mortgage Collaborative, joined by Eric Roman of Nations Lending Corp. As always, your comments, thoughts, notes, jokes, anything encouraged, just feel free to drop it in the chat or the Q&A, and we will voice it aloud. So, Eric, one thing you mentioned was, you know, just being able to capitalize on, you know, the fruits of 2020 and how you reinvest that into the future of the company. It's been a big topic on this program, a big topic in general with our lender members over the course of the last few months here. You know, in addition to overseeing Nations operations nationally, I know that you play a big role in really just kind of the transformation of the company as you guys continue to grow, being able to scale out your operation, always keeping your eyes and your ears on new tech, new initiatives. Anything in particular that has caught your eye as of late, or anything you're looking at as a leader that's you know, looking to continue to transform your company and grow it?
Yeah, on that front, we've been focused on digital mortgage for some time, and we kind of just finished that first phase with a point of sale solution. You know, beyond that, we've been automating workflow for the last couple of years and trying to just get the widgets through the factory much quicker, and that's going to kind of be an ongoing effort. But next up for us is kind of finish the swing around digitizing the mortgage process and getting to e-close here in the coming quarters. Definitely want to get that wrapped up in Q3 or Q4, so we can kind of hit the ground running in 2022 on it. Beyond that, big focus on operations. You know, how can we bring in some of this leading fintech to not only improve the mortgage process for the consumer, but also for our customers internally, our originators, our underwriters, our processors. How can we make their better process in the same token?
Excellent. And fellow Clevelander Jody Hall dropped a note in the chat, says, "Hey Eric, good to see you." Ironically, Jody, my co-host next week. So It's not only Clevelanders, so it just happens back-to-back weeks here. So, but Jody dropping the note reminds me, you talk about process automation. And it's something we've talked about almost every week on this show with different leaders that we've had on, and been not a divide, but there's some lenders like I know Jody and her team at Nationwide Mortgage Bankers. They're hiring a lot of developers and trying to build bots and other things internally. We've had other leaders and lenders that have said, hey, we're just trying to find the best off-the-shelf providers and the best way to integrate them into our organization. What's Nation's approach? Is it a buy? Is it a build? Is it a mix? As it relates to new tech?
I think you really nailed it on that last one. It's really a hybrid. It depends on what you're trying to solve, whether you're going to go out and buy it versus build it. And we've done both. For us, what we've realized is we can't scale our developers internally. So there's probably an offshore partner combination there where we can have some really good talent internally, but flex a lot of that work externally and cost effectively. So in certain cases, why reinvent the wheel, go out and buy it. But in other cases where we might want to differentiate a little bit more, there's definitely some of that innovation happening in-house.
Thank you, Eric. Some going on to some of the news in the industry as of late, a new home sale data just came out actually a couple hours ago. It actually came in a little under expectations for February, but just reading through the releases, attributed mostly to the really bad weather that we had nationally. New home sales obviously being new builds. They did revise up the January number, which was already strong. Going back to late last week, though, existing home sale data for February, pre-built homes that have been sold, those sales were up 9.1% year over year versus last February before the pandemic. But the really startling part of that report was that the median existing home sale price year over year was up 15.8%. We're seeing home values really skyrocket at really aggressive levels. Is that something as a leader in the mortgage lending industry that worries you at all? The potential of a bubble, that values are going up too much. There's too many things happening right now that are causing an unnatural increase to home values that could have some negative connotations for our industry, maybe in the years to come.
For us, I don't think it's something that keeps us up at night. When we look at, the financial crisis of 2008 and 9, credit was extremely loose. You had property values inflating very quickly, and that combination of both, we kind of all know how that story ended. But when you look at what's happening now, much tighter credit box, people are bringing in down payments, and it's kind of a different market with the millennial trends coming in. And it's not something that we worry about today when we see values increasing.
Speaking of the tightening of the credit box, obviously Fannie Mae made some news a little over a week ago when they announced some FHFA directed changes limiting the amount of investment properties and second homes that could be sold into the agencies. How did you guys react to that news? Have you had to do any shuffling when you saw it come out?
Yeah, if you think about the initial mission of Fannie and Freddie when they came into existence, it was really about facilitating home ownership. And since then, they've really expanded their offering, and you've got their ability to take on different products, investments, second homes, and so on. And I think it's they're really just thinking about getting back to the basics and how that partnership with the way their agreements are written with FHFA are handled. But for us, we had to look and take a look at, what's in our pipeline, what we've historically funded. I think if you look at the balance between Fannie and Freddie, I think we were just slightly over on Fannie, slightly under on Freddie. So we had to kind of start thinking about what we need to do to kind of curtail that business and find other outlets for it, whether it's non-QM outlets or really, giving the street time to react and understand, who's interested in buying that paper.
Yeah, it's interesting. If you read and if you Google, you can find it. The amendments to the Fannie and Freddie preferred stock purchase agreements, which prompted this change on the non-owner. There is other language in there that kind of spells out Fannie and Freddie's edict going forward from FHFA. One of the ones that really caught my eye was no more than 6% of purchase or 3% of refi loan volume, 52-week rolling period. Any lender that sells in the Fannie Freddie cannot have two of these three characteristics: CLTV above 90, a DTI above 45, or a credit score below 680. It sounds like, okay, well, but so a 675 credit score, 95% LTV, no more than 3% of your refi business can have those characteristics, 6% of purchase, something that I don't think a lot of lenders know fully. That is likely to be the next thing coming from the agencies. So should be interesting to see, how that all plays out, where now it kind of seems like, right, Fannie and Freddie are going to not be privatized, but they're going to be still run under government control, but under tighter rules.
Yeah, for us today, we deliver everything to agency, and it's worked really well for the last several years. But, some of these changes might divest that strategy to push a little bit more out to aggregators.
Yeah, because you have, think about with the pandemic last year, one of the changes in our industry that was a result of the pandemic was so many more lenders selling direct. I think, when all hell was starting to break loose in the spring and the aggregators started overlaying everything immediately, I think lenders started to see the value in delivering direct to the agencies. More of our members just did that, as opposed to the aggregators. So could see that kind of flow the opposite way here in 2021. And I think that, quite frankly, is, to your very valid point, more core to Fannie and Freddie, their core reason to exist in the first place. So moving onward. So the general dilemma, right? Right now we've been talking about an inventory issue in our industry for a long time. Like, inventory levels have been lower than the historic healthy level for a while now. But right now, I think it's the worst that we've ever seen. The most recent existing home sale report actually made that point, that the inventory is at its lowest point in history right now. So, reading through how people see this year playing out, I think MBA came out a few weeks ago and said, hey, this is going to be the biggest year for purchase maybe ever in the history of our industry. But that is incumbent on some new stock being released into the marketplace, either new homes constructed, or maybe some of these people that wanted to sell their home in 2020 that just didn't for some corona related reason. How do you look at the inventory piece of our industry right now? And how do you see 2021 playing out just from that side of our business?
I think you look at new homes are forming faster than builders can get the houses to the market. And, I think there's some drivers there, cost of materials, rising rates probably play into it. But for us, I think it doesn't stop us from continuing to focus on growing market share on the purchase side. It's just a matter of being able to roll with the economy and the changes. That's one thing that's constant. Like, the dynamics are always going to change.
Yeah, absolutely. Yeah, you can't control what you can't control, and you just got to keep trying to win more business in the markets you're in. So what about any of this, the wholesale lending madness? You following any of this with the Rocket, the United Wholesale? I always like to get the perspective of leaders from, large IMB members of ours. Those are the two biggest independent mortgage banks in the world right now. And do you look at them with, like, proud that IMBs are garnering a larger share of the marketplace, or do you cringe at some of the things you see in the news? How have you viewed the whole Michigan wholesale mortgage wars?
It's it's kind of twofold for me. It's on the radar, obviously, but knowing that you see these guys get to that place, that just proves anyone can get there, right? It's hard work, dedication, consistency, whatever. But it's amazing that IMBs are holding that spot, because that hasn't always been the case. It's unfortunate, kind of the back and forth what you're seeing between United Wholesale and Rocket and first and the other lender there, but Fairway. It's I think that sometimes in business it gets a little dirty, and I think some of that's airing out in the public, and there's a little humor in it, but it's unfortunate.
Interesting to see how that plays out. And it's mixed. I mean, I think, just talking to our IMB members, it's kind of the same thing. Like, it's good to see independent mortgage banks that are, and it does show you like, hey, like, United Wholesale was your guys' size, right? It was like 5 years ago, they were that size, 6 years. I mean, maybe not quite that soon, but it's been a very, very quick run up to going public and, really leading headlines now. So just goes to show that anybody can do it. And certainly independent mortgage banks have taken more market share over the course of the last, several years here. How do you view that going forward, though? The regulatory climate, it's been more tame these last 4 years. Obviously, you got a new presidential administration in now. You got a new CFPB. I didn't read the column yet, but one of the email newsletters I get this morning, it was like the headline was like CFPB, to lenders, we're back. Like, you guys are a very compliant organization, very buttoned up and well run, but just from a strategic standpoint, like, how do you view that when you change administrations and you're going to get a new CFPB essentially?
It's kind of a step backward. It's really just a distraction, but it has us thinking about things like going backwards to potentially CFPB mock exams to kind of get readiness play. And you just everything I've heard and experienced, when you have these type of examinations, they're a huge drag on your workforce. They take weeks to months, and you're almost going to come out of it, guaranteed with some kind of implication on some portion of your business. So, for us, it's thinking about readiness and, trying not to lose sleep over it, but it's a fact of where we are in the industry today.
This is the last week in Mortgage Today. I'm Rich Swerbinski with the Mortgage Collaborative. This week joined by Nation Lending's Corp's Executive Vice President Eric Roman, just kind of hitting on all the latest and greatest in the never a dull moment mortgage industry. Eric, sticking just for one more second with the CFPB and regulatory matters, fair lending. Have you started, like, I guess for years, depositories, as you know, that's my background, are kind of tasked with, CRA guidelines and, being able to prove that you are making applications in the markets that you're in that match kind of the demographics of those areas. Nobody from the new CFPB has come directly outright and said that there's going to be changes along those lines. But as a leader for an independent mortgage bank, is that something that is in your mind that maybe you guys are starting to take a look at, your application mix, fair lending tentacles, and the mix of applications relative to the markets that they're coming from?
It is. So we've been sensitive to it for several years, going back through a couple of administrations to where the CFPB kind of had those fangs out initially. And we partner with a consulting firm that specializes in fair lending, and that's been really helpful to kind of make sure that we're doing those testing of our LARs and our HMDA data to make sure that there are no issues and we're ahead of it.
Excellent. We've got about 10 minutes left with Eric Roman from Nations Lending. This is the last week in Mortgage Today. Eric, refi, I don't know how many times in our careers we've said, oh, the refi boom is over. There's not going to be no refis left after this. Outside of people that need to take cash out or want to take cash out, and they'll do it regardless of what the rate is the real refi boom, is it over?
I don't think so. We've heard this forever, and we continue to do refi depending on, market conditions. As early as last week, 52% of GSE mortgages were at least 50 basis points in the money. Obviously the rate environment's going to continue to dictate, what that looks like moving forward, but we see a future in refi for the continuous future, regardless.
And one of the, there's negatives to the run up in home appreciation, the affordability aspect, the risk of the fact, values potentially appreciating too much that could have negative impacts. But one of the good parts about the home appreciation that we're seeing now is it's giving existing homeowners equity. It's giving them the ability to borrow against their home at a low rate. And we should see a good, healthy cash out refi activity for these next couple of years, right?
I think so. And I think the return of the home equity line might be something that looms back into existence.
That's a great point. Yeah, I mean, it's been something we haven't talked about a lot in our industry these last couple of years, but yeah, being able to borrow in chunks and only pay interest on what you need, that aspect, tapping into your home equity, yeah, could see a lot more of that in the months and years to come. So. What about margins? We know last year was just an incredible year for volume and margins. We know that application volume just globally has fallen off a little bit these last few weeks. To what level have you seen margin compression start to occur?
It's real. If I go back, 30, 45 days, we're probably seeing a 150 basis points difference in conventional business, in that shorter period of time.
Yeah, so that is significant, and it's consistent with what we're hearing, from other members of ours. And do you see, and then thinking more about the competitive landscape? I was talking with Rob Krisman about this on our last show that I do with him, just the fact that we could be heading into a really aggressive merger and acquisition cycle for our industry. You have a lot of large or medium large lenders, obviously, that made lots of money. You still got a lot of business owners in our industry that are older. I've talked to more than a couple that, have said, like, I'm riding this refi train out, and I'm calling it a day. I'm not ready to deal with another Democratic CFPB for 4 to 8 years, and it's no when to say when. How do you view the merger and acquisition part of our business? Do you agree with my assessment that this could be a couple of years of incredibly rampant M&A activity for our industry?
I do. I think you nailed it. Looking at this refi market, people were there 18 months ago. They were having the same thoughts. And then, this refi explosion comes in, everyone's got to make hay while the sun's shining. So they're just doing what makes sense for where we are in the marketplace. But I think it's definitely an opportunity that's going to continue to open up. We're very interested in that. We have those conversations with interested parties, and we're looking to do the same. And same on joint ventures. It's just, for us to continue to grow at scale, you have to do some M&A deals. You have to start up other ways to bring in retail business.
Yeah, and this has come up the last couple episodes of this show, joint ventures. Other leaders from lender members of ours making the prediction that 21 and 22 are going to be huge JV years. To the lay person, lay out, I guess, the justification for that as a valid extension of your growth and business strategy.
They're not necessarily easy to facilitate, but think about a real estate brokerage, right? So you've got a owner of a real estate company. He's got, several agents. In that model, they're generally paying out the lion's share of the commissions to the agents, right? So those owners are living off of a little bit from a lot of agents in some cases. When you can come to the table and you can say, hey, we really like your brand, we'd like to partner with you. You kind of go into it like, hey, what if we can earn an additional 50%, or however you structure the deal, and partnering with them? You form a new company, it's a new entity, and the idea is capturing a percentage of that business and a new channel into your IMB company. So it's valid. The model's proven it works. You have to work it. You have to have a good partner on the other side, and you have to focus on a good capture rate of that business, because you're not going to get 100% of it. Those agents have relationships with other lenders or LOs. So if you can capture anywhere probably from 20 to 25%, I think you're in a really good spot, but it's definitely a viable option.
Very well put. And yeah, thanks for sharing that with us. And got just a couple minutes left here in the last week in mortgage today with Eric Roman from Nations Lending Corp. And Eric, turning our attention from recruiting and growth and channel strategies to retention. One of the other just parts of this last year is, the whole work from home dynamic, right? Lenders now, they don't view, if you're a lender in Ohio, you don't have to hire people that live within an hour of your physical location. People have operational employees, living all over America. I think that that's making more lenders think about lending in different states. And, if you're managing a large team of operational staff that's spread out all across America, the processor, underwriter, or closer, they could work in theory for any mortgage lender in America now, and not just the ones that, so from a retention point of view as a leader, that's something that's a new challenge, right? That you got to deal with.
It is, and it isn't for us. We have had a remote workforce for years in portions of our operations. And one of the drivers there, even before the pandemic, has been like expanding that talent pool to outside of your market, right? You can really level up if you expand that to a nationwide search. So that's worked really well for us. I think the pandemics really proved the hybrid or remote workforce is viable, right? The landscape has changed forever. I'm not saying we'll never get back into an office. I'm here today, right? But I think it's going to look different. It might be a flex week, maybe you spend a couple days in the office, a couple days remote. But in surveying our employees, there's a big want now and desire to be in either a hybrid or a remote situation. Think about the time that you're giving back to these employees with, sometimes, an hour or two of commuting, where now, they're spending that quality time with their family, or they're working longer hours. And that's really something that we're passionate about. It's like that healthy work-life balance. And, I'm sure as the pandemic starts to repeal a little bit more and more, we'll understand what that looks like more. But I don't see a situation where we ever get back to 100% capacity in the office.
Yeah. So, you talk about tech. You're one of the more tech forward guys that is part of our network. That's been really a central part of your role for many years now at Nations. You laid out at the outset of the program, some of the major technology initiatives that Nations is in the middle of right now. But as somebody that has your ear really close to the ground of the emerging technology world, anything out there, any nuggets, anything out there in the marketplace, maybe a prediction, something that, people aren't thinking about or talking about that you could see, being a big part of the narrative in our industry in the coming months ahead this year, or just anything unique, interesting you've seen out there in the marketplace as somebody that spends a lot of time looking at, where the puck is going?
Yeah, the biggest one for me is the peer-to-peer decentralized payment system. Everyone's calling it crypto, and you see all these cryptos emerging, and they're using blockchain technology. It's becoming so mainstream. You're seeing Fortune 500 companies put Bitcoin on their balance sheets. What does that look like for the future of lending? Does it inch its way in there some way, shape, or form? Imagine offering compensation packages to your senior leadership, your branch managers, your originators, where they have an option to get paid out in Bitcoin. What does that look like? That's
very interesting and relevant, and I knew you'd have a good nugget for me there. And I mean, that technology, it in practice and in theory works good with our industry. If it's blockchain technology or electronic transfer of currency or crypto, like it does work in theory well with housing finance in our industry. And it doesn't seem like there's anything groundbreaking that's looming in the next month or so, but it doesn't surprise me if that's something that you've got your eye on. So
I think you got to get the administration to buy into it. Today, I don't think they are. There's back and forth there, but I think it's here to stay. And I think that there's a high probability that it finds its way into the industry.
Eric, as always appreciate your insight. Always enjoy the conversation about the industry. Thank you, my friend.
Hey, thanks, Rich. Thanks for having me.
All right. And to all our attendees, thank you once again for joining us. We're here every Tuesday at 2 p.m. Eastern for the last week in Mortgage Today. As noted earlier, next week's co-host, Jody Hall, the president of Nationwide Mortgage Bankers. So we'll see you next Tuesday at 2 p.m. Eastern. Have a great week, everyone. Take care.
Thanks, guys.